Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. I want to thank everybody for joining us today. My name is Robert Kuhn. I am the host of this radio show, Destination Retirement, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary. Everything we do is to bring strategies to the table that can deliver positive returns, even if the markets are down. Down to a point, of course. Our enhanced yield income notes that we utilize from the biggest banks have 30% downside protection. Our tax strategies are as robust as you're going to find. And then our traditional, I'll call it boring asset management, is quantitative in nature. So our offering is tough to beat. And as you if we've talked, I think you've recognized that. So a lot to get to this week. Hopefully everybody is enjoying their summer. Finally, we had some nice weather this week. Hope every father, stepfather, those acting as a father have a happy Father's Day. We're going to talk about the new bull market. Is it on shaky ground this week? But as always, if we can help you in any way, please reach out to Paige. She will be able to schedule that appointment for you. The initial consultation can be a Zoom. It can be in person. It can be over the phone. It's really whatever you're comfortable with. So 630-492-1912, 630-492-1912. And we'll get that set up. So let's see here. The enhanced yield income notes are still pricing very, very strong. We did a JP Morgan note this week. Well, actually, it was last week, and it came in at 12.2. So 12.2% annually. That is paid monthly. Broken down into monthly payments, and you can obviously do the math there. It's a little bit over 1%. The outreach has been incredible about those notes, and I have to take a step back because these are so second nature to me, but we're constantly hearing people who are working with other advisors who listen to the show, reach out to their advisor and ask about the enhanced yield income notes, and they just don't have any real clue of what they are, which is kind of surprising because this is not a cutting-edge strategy in any way, shape, or form. This is not a fringe strategy. This is not a strategy that doesn't capture significant assets. I mean, if you look at the structured bank notes as a whole, it's north of, at least it's reported, it's north of $200 billion a year and well over $1 trillion, multiple trillions, I would imagine, of strategies or of current investments. And so I think it's really shows a larger problem with the industry. I think advisors, unfortunately, especially if you're mildly successful, you're probably making, well into the seven figures in most cases, and you're living a very good life, and most advisors, unfortunately, are not going to incorporate new strategies, and it's just they're going to use more of the same, and it's a problem. It's a problem with the industry. It's a problem because there's we're going to start to talk a lot more about perception versus reality. We're actually building a presentation on perception versus reality because what people perceive that they have is in most cases in reality is nothing comes close to what they perceive that they have. And if, I just, again, our goal, is $100 million, which is pretty lofty from July to July. So July 25 to July 26 in the income notes, the enhanced yield income notes. And again, it's just an overall piece of the pie. And we certainly have people most of the time, if individuals are working with another advisor, and they are not ready to leave that advisor yet, but they're intrigued by the enhanced income yield notes. And candidly, why wouldn't you be? I mean, if you could get double digits with 30% protection, backed by the JP Morgan, Citigroups, Bank of America's, Morgan Stanley, UBS's of the world, the largest and what we would consider to be the most financially stable banks in the world, why wouldn't you do it? And so we do have, a lot of people here recently coming to us and saying, we really love the strategy. We talked with our advisor. They don't have a real working knowledge of what those strategies are, which is shocking to me. And if they don't make a living in those strategies, like that's a core component of our practice. That is a core component of our practice. And so we have the relationships in place. It is a scale business. It is a volume business. And we do the volume to get better, my belief is, most instances, much better rates than somebody who's just going to do it, an advisor who's just going to do it one-off, because we have the relationships that can lean on the banks. And we, have done enough business with our partners in that area that, we get higher yields, and that's just the way it is. And so for those individuals who are not ready to make a wholesale change of advisors, I would ask why, because, that's something certainly to consider. But again, it's never our agenda. It's always your agenda, and we're very respectful of other relationships, and that's fine. But this isn't cutting edge, and you have to look at the bigger picture. I think the problem in the industry is that advisors are not staying at the forefront of cutting edge strategies. I mean, and it's, some are good, some are bad. And an advisor has to vet it. And if you're just doing a traditional buy and hold type strategy, 60-40, 70-30, balanced type strategy, I mean, how is that paid off for you? Look at your fixed income. Look at your fixed income holdings and see, how that performance has been. I mean, most individuals who want cash flow are, for some of their money, their advisor is generating 4, 5, 6% in cash flow, and it's probably closer to the 4s. Maybe the 5s, when you could have a strategy like this that, is going to be double digits as long as the indexes aren't down 30%. That is significant. That allows the other, pool of money to invest for growth, for tax-advantaged investing, and you're not having to allocate as much. And so we don't necessarily talk enough about cash flow generation on the radio, and I think we're going to start to do it more. 630-492-1912, 630-492-1912. And so, most of the, cash flow generation that we see is just, tied up in some sort of a bond or some sort of a guaranteed income annuity. And goodness, I mean, look at those yields. The bond strategy, as I mentioned, I mean, all the time on the radio, I mean, we're in the worst 5-year drawdown in history of the bond market. And you're, tying up your money if you're just buying, a bond mutual fund or a bond ETF, which is what most advisors are doing nowadays, or a managed account, but they're still buying individual bonds. I mean, your 10-year bond, just go look at the AGG. I mean, that's the aggregate bond index. I mean, under 2% for 10-year annualized. I mean, think about that. Absolutely terrible. So I want to really challenge you and challenge your advisor on how you're generating cash flow. And again, most people want to generate some level of cash flow from their portfolio at some point, or they're going to at some point. And we're in a very, very competitive space when you can do, like the last note, was 12.2. We did a JP Morgan during the volatile period in April. It was 15.4, which is off the charts. I mean, don't expect that unless we have another, period like we did in April where the markets were crazy. But, 12 to 14, generally speaking, plus or minus maybe a half a point is where we're, pretty consistently getting on the notes. And again, all the banks are the biggest banks. I mean, they're just the massive banks, and it's a senior unsecured debt of the bank. And you can look at the prospectus, and it says guaranteed by whoever issues it. So a couple moving parts, but I really am thankful that individuals who listen to me on the radio and listen to us, through our other outreaches, which we're going to greatly, greatly pick up. And so more to come on that. throughout the summer, we're really excited about kind of, our growth initiatives of getting the message out. And it is serving in a way. Obviously, we build the business, which is always good, right? I mean, we're all, in a business to grow in some level, but, our mission as a firm has always been to provide, the same types of strategies that we would personally invest in as advisors and bring those to you, because, I mean, investing is very simple. Just don't lose money. I mean, that literally is it. And advisors are going to tell you that, but unfortunately, I can look at your portfolio and tell you that you have nothing inside of that portfolio that will do that. And I really want to challenge you, during this first segment on a couple thoughts. First of all, how are you going to generate cash flow, and what yield or what interest rate is your advisor, talking to you about? Are they still talking to you about the 4% rule, which is just absolutely so dated? And it's just mind-boggling. But again, Wall Street does basic stuff. Advisors do basic stuff, so it's easy to understand. It's easy for you to digest. I don't really care about that. If it takes us 10 meetings for you to understand fully what we're doing, at whatever level you want to understand at, whether that's 30,000 foot or whether it's in the weeds, isn't that our job? I mean, my job is to make sure that we're crafting a portfolio that if and when the markets stop going vertical, which, I think is obviously a period of time that we're in now, that you could still make money. And, that's our job. And that's our job of advisors, is always to, reduce taxes. And when we talk about taxes, again, I don't talk enough about our tax strategy in the energy space on the radio. I need to. I absolutely positively need to. But we do have 2 webinars out, finally. I did a webinar on the banknotes, just a 15, 20-minute primer, so you can watch it, at your leisure and see if it makes sense for you before, you reach out. And then we also have a webinar on the energy strategy. And when you can bring those, we bookend those in our offering, I'll put our offering against any other advisor really in the United States, but 100% here in the Midwest. When we can bring an energy strategy that can reduce your taxable income by, 80 to 90% active or passive per $100,000 invested, and still have, targeted, double-digit distributions and cash flow on an annual basis, that's only a 3 to 5 year targeted investment, investing directly alongside of the Exxon, Chevrons, Conocos, EOGs, Matadors, Mewborns of the world, the biggest and the best. It's just a very, very tough for other advisors to compete with what we're doing. And we like it that way because we know that we're adding value to you. And at the end of the day, that's our job. So we're going to talk about the bull market. Is it on shaky ground next segment? So if you want to reach out and get on our calendar, give Paige a call, 630-492-1912, 630-492-1912. More after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent registered investment advisory firm and a fiduciary. Our elevator pitch, our 30,000-foot pitch, or whatever you want to call it, what makes us different is very, very simple, incorporating strategies that can still deliver positive returns in negative markets to a point, and strategies that can greatly reduce your taxable income. I promise you, if you are at a big bank, a big brokerage firm, chances are probably 99.99% that your tax strategies are so limited. Most advisors today are going to talk about tax loss harvesting, which is matching gains with losses. I mean, that I think would just be an automatic. I would compare that to our tax strategy that we incorporate, which is, what we've done is, create a fund and energy strategy with who we believe to be industry experts, the best at the best of what they do. That can reduce your active or passive income generally by 80 to 90% of however much you invest. So if you put $100,000 in, you're able to reduce your taxable income, 1099s, capital gains, what have you, by $80,000 to $90,000. Think about that. Think if you're a high wage earner. Think if you have embedded capital gains. Think about if you have sold a business, sold concentrated stock positions. It may or may not be for you, but these are the strategies that advisors are most, at least I would hope, or advisors are utilizing for their own personal money. Because I'm convinced, with the experience that I've had since 1997 in this financial advice business, is that most advisors are not investing their personal assets the way that they're recommending clients to invest theirs, and I think that's a problem. I think that's a huge problem. And again, our average client is kind of that $500,000 to $15 million of investable. Certainly, more. We have higher net worth clients, of course, but we have been a kind of, that's our niche. Really, it's kind of 1 to 15 million. But again, for those investors that have $500,000, those investors that have 300,000, those investors that have 20 million of investable assets, I mean, you're getting the same intellectual capital and team and power that we do and we bring to the table for all of our clients. But most individual advisors are not investing in buy and hold strategies, balance strategies like they're telling their clients to do. It's hard to scale when you're doing what we're doing, when we're bringing actual real strategies that you generally can't get access to. That to me is so critical, so absolutely so critical. And if that interests you in any way, give Paige a call, 630-492-1912, 630-492-1912. The bank notes, the enhanced income yield notes, 12.2 was the last note, JP Morgan note, that with 30% downside. I mean, that to me is a great bond replacement. It's a great income annuity replacement, which is where, where the income rates are now on annuities. And if you listen to the radio show, I think more times than not, their their annuity pitches wrapped up in a financial show, and they're going to show you these ridiculous illustrations of 12 to 13% guaranteed returns and income doubling and tripling and having absolutely no market risk. And those that are on the radio know who they are that show those strategies to clients. We know it because inevitably people who talk with us talk with other people on these radio stations. And as well as I do that that's garbage. And shame on advisors for not explaining to clients what it really is, and it's back-tested data, and it's not showing real returns. And so if you're being shown those strategies, and if you're own those strategies, I think you really need to identify, is that the best way to generate cash flow? And you need advisors like us that what in the annuity space, the problem is that those illustrations, and I wish they would change it. They can show hypothetical back-tested data. Well, when you show hypothetical back-tested data versus the real data, since they've actually started running money, the difference in returns is staggering, absolutely staggering. And so when you make a decision, when an advisor makes you make a decision based on illustrations, inevitably a year or two down the road, you're just not happy. I mean, it just happens all the time. And if you're in a strategy like that, it's, what are you going to do when inflation goes up? I mean, you have to really start to think about cash flow. And for some people, they're not a bad strategy. If you have, in my opinion, at minimum 5 to 10 years to wait before you need income. But again, everybody's individual situation is a little different. But I think the enhanced yield income notes are the great annuity killer for cash flow because, again, if we're getting 12% with 30% downside, I mean, you can do the math on that. I think that's going to allow you to certainly, keep up with inflation and have significantly higher cash flow. And again, it's not that we don't like annuities. I mean, annuities are one of our protected growth bucket strategies, but it's not an income annuity. It's an annuity that's only 5 years in duration. And currently, the one that we are using, you get the first 10.75%, or going to use actually, 10.75% of the S&P. And so it's a great, fixed income replacement. I mean, it's a great, strategy to hedge away some of the risk of the equity risk in the market, but still get, again, 10.75% tied to the S&P 500. So you get the first 10.75. I mean, that's a pretty strong strategy. So, I mean, when you look at, is the bull market on shaky ground, I think investors are turning a blind eye to the risks that could certainly derail the bull market. And it's, I think caution is warranted. I think geopolitical tensions and legislative uncertainties, including debates on bank regulations and the U.S. tax bill, they pose, in my opinion, risk to the equity rally. And the market is very, very optimistic on earnings and growth. And unfortunately, I think that is, lacking some evidence. And when you look at, the CEOs that are coming out and kind of sounding alarms at various degrees, you have to pay attention to this. Risk happens fast. Risk happens when you don't expect it. And if you're not prepared for risk, you could lose money. And if you lose 30%, it's what, 42%? I don't have the math in front of me, but 40 some odd percent just to get back to even. And if you're in retirement or you're 10 years out from retirement, those are very, very important times. And my question to you is, why don't you have a defined outcome strategy in your portfolio, like the enhanced income yield notes, where you can get whatever the note pays, 12, 13% with 30% downside protection. So you're still making money in a negative market to down 30%. Just think about that. You're still making money in a negative market to down 30%. That is significant, and shame on advisors for not sharing with clients that these basic strategies exist. Everybody has an industry out there that you work in, and a basic topic to you, like the enhanced income yield notes, those are second nature to me. I could articulate them to you in 30 seconds. Watch our webinar. But if you're in an industry and a basic topic to you, it may be foreign to me. It may take me, 15, 20, 30 minutes to fully understand it and grasp it. But the outcome is so dramatic. I mean, if you can make money as long as the indexes are not down 30% and the bank is still in business, which, goodness, if, the banks we use, the JP Morgan, Citis, Bank of America's, UBS's, Morgan Stanley's, BMO's, Goldman Sachs's of the world, if that happens and we have to start worrying about that, then, I would have to say that this is the least of our problems. Individuals, unfortunately, a lot of times they're not prepared for months like April or years like 2008 or years like 2000, 2001, and 2002. And so all they can do mentally to cope with it is just to sit and take it and rely upon market averages and know that it's going to come back. Well, yeah, it may come back. I mean, it always does come back. That's not even up for debate. But again, if you've listened to the radio show, please hear me. If you bought Microsoft in 2000, it took you 14 years to get back to even. 14 years to get back to even. So I think, a heat-seeking missile aimed at what comes next, often with, seemingly no regard for what has already happened, man, that's kind of, what the market is. And, we have to make sure as advisors that we are articulating to our investors exactly what could happen inside their portfolio and crafting a portfolio that can still deliver, for at least some of your money, can protect principal and still deliver positive returns. And then, the last chunk is to reduce your taxable income. But the good news is for us that very few advisors, certainly here in Chicago, do bank notes, the enhanced income yield notes, and even fewer advisors have any access to an energy strategy. And the beauty is that energy strategy is mine and ours, and it's a fund that we created, so we can greatly reduce, your taxable income with that strategy. And this is not gray. I mean, it's black and white. Now, of course, we don't provide financial advice. Best practice is always to reach out to your trusted professionals before you invest in anything, but they are very, very basic. So more after the break, 630-492-1912, 630-492-1912. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary. Our job is to incorporate strategies that can deliver positive results in negative markets, that can protect principal in negative markets, and can outperform the S&P over a market cycle. Again, past performance is not indicative of future results. Understand that. We're not the type of advisory firm that's going to push or market outsized returns because, candidly, we don't want those clients. Those clients generally just jump ship occasionally from time to time, and we're not into renting clients. With our financial planning process, which we'll talk about here in a minute, generally when we do the work needed on the front end, we want to keep clients for life and future generations. So 630-492-1912, 630-492-1912. A lot of Roth IRA conversations recently with people who have significant assets, people who have $5 to $10 million, and they think that the Roth doesn't make sense because the income that they're in, the income bracket currently. Well, the challenge is, we're financial planners first, and we identified that that was a lacking part of our business, and we addressed that beginning of the year with the hiring of Brian, our certified financial planner, second to none, best at what he does, in my opinion, which is why we hired him. But we recognized that our financial planning wasn't, where it needed to be, and so we addressed that as a firm. And when we look at financial planning, intuitively, most individuals know how much money they can spend. I mean, you can do back of the napkin type math, Excel spreadsheet type math. I mean, that's pretty easy, right? But again, our financial plan will show you that, but it will also show you your lifetime income tax that you're going to pay. And it's a misconception that if you have an IRA that's seven figures, multiple seven figures, when you're forced to start taking money out with RMDs, you're going to be in a significant tax bracket. And with proper planning, we can really mitigate that. And when you look at kind of wealth transfer, the Roth is still, in my opinion, the single best strategy out there because you can pass those assets on and they can still grow tax-free for 10 years currently. 10 years tax-free, and they could take all that money out in the 10th year. Now, they can take it out sooner, of course, but the point is that the financial planning process will look at all of that, and we can run in our tax software, which I don't know of a single advisor that absorbs the cost of the tax software that we do. Doesn't mean that I'm certain other advisors do, but I don't know of any, not in my circle at least. Now, again, we're not tax professionals, right? But this allows us full look through to everything and making sure that we can convert as much to a Roth without bumping you up to a higher tax bracket. The level of detail will just blow your mind. And I'm so proud that we addressed that because I personally don't find financial planning fun. I just don't. I mean, I like the investment side, but that's why, we addressed that and hired what we believe to be, certainly one of the best certified financial planners that I had the opportunity to meet with. And I think you'll, agree with me when you meet with him. But the financial plan can really walk through a lifetime tax reduction strategy. And that's what we're here to do. So you have an IRA, you make a bunch of money, seven figures or $500,000 or whatever that number is, multiple seven figures, and you don't think a Roth is for you. Well, it may not be today, but it could be tomorrow. It could be, soon. And when you can incorporate, that with what we're doing on a tax mitigation strategy in our energy fund, I mean, think about that. If you put $100,000 in the energy fund and you get, say, $85,000 tax benefit, $85,000, and that's active, passive, capital gains, whatever. Well, we could basically do a Roth conversion while not adding any taxable income to your tax situation. Again, best practice, always bring in your CPA, your tax professional. We work with them all the time, not an issue, because we can't provide tax advice. But I've found that CPAs look at year-over-year taxes rather than lifetime taxes. And so that's kind of an issue that I think that we have to address with our current clients. Our CPA will say, oh, no, it doesn't make sense. Well, maybe it doesn't this year, But what if we paid a little bit more in taxes now, and then for the next 20 to 30 years, we reduce your tax bill? And that gave you more money to spend. That gave you more money as a legacy if that's an issue or something that you wanted to take a look at. So these are the things that we do on a daily basis. And if you haven't done it, if you want to utilize, our tax strategy software, certainly just reach out 630-492-1912, 630-492-1912. Again, on the enhanced income yield notes. Last note, we priced 12.2 annually. JP Morgan, 30% downside before you don't get paid your monthly interest payment of just over 1%. So 30% protection to make 1% a month. Currently, we price them almost every week just with the volume that we do. So if you have any interest in the enhanced income yield notes and you want to talk about cash flow generation and taking less money to generate more cash flow for yourself, certainly we'll have that conversation. 630-492-1912. Also, the stress testing software. I don't think I talk enough about that on the radio. Our stress testing software, we believe, is second to none. Again, these are not things that we create. We just vet and we absorb the cost, and it's just generally cost prohibitive for an individual to utilize the tax reduction software, the stress testing software. And what I have found is that the majority of people working with advisors like them. They like the advisor that they're working with. And I get it. We had a potential client come in this week, and he said, multiple $1 million account, had done very, very well for themselves, sold a business, et cetera, and really like their current advisor, and they're going to stay with their current advisor for a period of time, and maybe they will never leave their current advisor, but they're starting with the enhanced income yield notes, it looks like, for a relatively significant investment because their current advisor, they could tell, just didn't have a real good understanding of what they were or what they are. And by the end of the meeting, they understood that maybe what they have is just very, very cookie cutter, very, very boilerplate, and dressed up as something proprietary, dressed up as something unique, and it's not. And we find that more and more. And so we encourage you to challenge your current advisor. We encourage you to have a stress test run. Really check to see, is there value being added to your portfolio? Because more times than not, we find no. The only real risk management that you have inside of your portfolio is the market going up. And always remember that statistic. Always remember that statistic. If you bought Microsoft in 2000, it took you 14 years to get back to even. Again, yeah, it was a tough time in the tech space. Of course, you bought it at the wrong time, but who's to say that we're not there currently? I mean, you look at listen to the CEOs. Don't listen to me. Listen to the CEOs that are coming out, sounding the alarm on the economy. So you don't have to listen to what I say. And I mean, nobody has a crystal ball. Nobody knows what's going to happen tomorrow. But here's what I'm fairly confident that most investors would like. They would still like to make money for some of their portfolio, even if the markets are down. So think about that. The enhanced income yield notes. You have 30% downside protection before you don't get paid a monthly coupon payment. We're not talking about, minimal interest rates here. I mean, 12.2% annually was the last JP Morgan note we purchased. And it's a prospectus item. So you can read the prospectus before you invest. I mean, that's fine. I mean, this is very basic stuff. But I'm very confident that most individuals would have or like the ability to reduce their taxes significantly, active or passive income. They would like the ability to have some money that's sheltered against market loss in its entirety, but still tied to the S&P 500. And currently the cap on those strategies is 10.75. So no downside. You get the first 10.75 of the price movement of the S&P 500 annually. When you get a gain, it's locked in. And then the enhanced income yield notes, let's just call them north of 12. That's where they're currently pricing. And you still get that 12 or whatever the note is paying, as long as the indexes are not down 30%. And then you look at your more traditional asset management, which I didn't get to the performance on the last segment. But the strategies that we use are all cap strategy. It's not ours. I mean, we bring, we're giving you access to the managers, but significant outperformance of the S&P since 95. The all cap and focused growth strategy together, 50-50 split, has a cumulative outperformance of the S&P by almost 1,200%. Now, that's only about a 1.5% to 2% a year, in which most people think, well, it's not too much, 1.5% to 2% a year. Well, you do that over time, cumulative, almost 1,200% outperformance. So when you look at the offering that we're bringing, whether it's tax reduction, whether it's defined outcome, predictability, the ability to generate positive returns in negative markets, and just your traditional core asset management, we're tough to beat. We truly, truly are. And my job is to educate you with data. Our job is to run the plan, show you your lifetime income tax. How can we reduce that greatly? How can we, if your goal is to leave a legacy to future generations or your children, how can we do that as tax efficiently as possible? How can we put that in an asset that can grow tax-free for 10 years after your death, that they can let grow tax-free and then take the money out on the 10th year? And it's not an insurance policy. I mean, these are the basic strategies that are out there that we're utilizing. And we've we're really excited about an announcement that we're coming up with for your kind of your growth money, a new strategy, a new fund that we're personally managing that will have probably the bulk of our personal assets invested in as well, right alongside you. But we're ready to launch that in July. July 1st is the target date for that. So that's a whole nother strategy that's event-driven, that is there to take advantage of dislocations in the equity markets and individual stocks that we're super excited. So more to come on that as well. So a lot going on here at Kuhn Capital Partners. And if you want to be part of it, if you want to learn about it, if you want to learn more of the enhanced income yield notes, the tax strategy, just certainly give us a call, 630-492-1912, 630-492-1912, and we'll have that initial consultation. Generally, it's short. Can come to the office. You can do a Zoom. You can do a conference call, whatever works for you. It's never our agenda. It's always yours. So more after the break.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary. Big things, but I think everybody should always act in the best interest of their clients. So, that's just who we are. We've built a great business. We continue to build a great business. And the only way that we can continue to grow is by showing you and articulating to you the industry deficiencies, why investment advisors are not bringing you risk-managed strategies that can deliver positive returns even in negative markets. Because who bears the risk of a down market? Buy now or pay later. That's kind of the way that we look at the market. It's you either do some education now, or you're going to pay, if and when the markets go down. And I get why advisors do basic stuff, because it's easy, it's scalable, they can raise more money, and they don't have to necessarily be educators. And the reality is the markets are up 3 out of 4 years. So inevitably, their clients are going to win. But what is winning, right? To me, If you just want to have a buy and hold strategy, if you don't want to, have enhanced income yield notes that can deliver, double-digit returns with 30% protection that are offered by the largest banks in the world, okay, fine. If you don't want to reduce your taxable income greatly, that would allow you in many instances to do more Roth conversions to mitigate your lifetime tax bill, okay, fine. But, my job is not to tell you that you need to do it. My job is to show you the data. Let us run out your RMDs for every year of your life out to 95, and let's show you that if you have a 7-figure IRA, you may pay $2 to $3 million in lifetime taxes if you live to 95. Let's show you how we could maybe pay a little bit more in taxes, possibly for a few years, to save you all of that tax money for 20 to 30 years. Again, it's not my job to tell you to do it. It's just, my job to show you the data. And that all comes down to the financial planning. And that's, it's just we meet with too many people who will say, have you looked at, your lifetime tax bill that you're going to have to pay? And they'll look at us kind of sideways like, well, what are you talking about? Well, if your current advisor hasn't run out what your expected lifetime tax is, I think that's an issue. I think that is a huge, huge issue. And here's the beauty of it. We do that with our financial plan before you're a client. And I have to guess that we could probably charge $2,500 for our financial plan, $2,500 for our portfolio stress test. But we're going to do this for you before you're a client because it's just it's really an investment in our future relationship that we're willing to do before we know if you want to work with us or not. It gives us some insight into who you are, your current situation, and more importantly, it gives you insight into who we are and the level of detail that we will take everything to. Most people call because of the enhanced income yield notes. I get it. When you hear me say, you can get an investment backed by the JP Morgan, Citigroup, Bank of America's, Morgan Stanley, UBS's, BMOs of the world, the largest financial institutions, that is going to pay double digits annually, paid monthly, as long as certain indexes don't drop 30%. I get it. I get why people reach out. That is generally, the people reach out for either that reason or the tax strategy. And I get it. When I can talk about an investment in the energy space that has significant tax benefits to the tune of $80,000 to $90,000, generally speaking, per $100,000 invested, you could reduce your active or passive income if you sold a property, sold a business, high wage earner, et cetera. Those are two very distinct advantages that we have over others. And why do you think we talk about it on the radio so much? That's generally why people reach out. It's very rarely is it, well, our all-cap focused growth strategy since 1995 has outperformed the S&P cumulatively by almost 1,200%. Most people don't reach out because of that. It's the ability to generate positive returns in negative markets with the enhanced income yield notes. It's the tax strategy to greatly reduce your taxable income. But what they find out very quickly is that that's just a small piece of what we do. And when we go through the financial planning process, and it's not labor intensive. I mean, it is absolutely positively not labor intensive. It's a 30-minute meeting for us to capture the information, a few hours of prep to complete the plan, to look over the plan, to identify the talking points of the plan. But people find great insights into an advisory firm that actually goes to the level of detail that we go to. And if you haven't been shown your lifetime income expected tax bill on a year-over-year basis, running it out to age 95, you are not with a great firm. They may be great people, and you have to separate the person versus the advice that you're getting, and that's very, very important. But if you haven't been shown that, why? Because it's just more money that hopefully we can give you tax-free that you're not going to have to pay taxes on the gains. And it's just more money that if you so choose, if one of your goals is to pass money on to future generations, i.e. your kids, your grandkids, we're just allowing that at hopefully a greater level. And it all of that we talk about, it's not, we spent, this is basic 101 stuff. This is basic stuff. This isn't, we found some way to get around some tax code or, like the energy strategy. This isn't, we're slick and there's a gray area and we're taking advantage of it. It is very clear, the tax benefits of energy investing. Very, very clear. But geographically, it's just not shown. Advisors don't have access to it. Illinois and the Midwest is generally not a energy, the Midwest is not providing energy for the United States. And so to the extent of, Texas and, what's, other areas of the country. And so generally you're just not going to be, those strategies, unfortunately, aren't shown to you. And the way I look at it, it could be we could go out and sell mulch. If they had tax benefits that, were legit and in the tax code forever, and selling mulch provided that, well, then it's something that it's the job of an advisor to vet and to make sure that we're bringing that to the table. So I think our insights are unique. Our insights give us a competitive advantage. What we do gives us a competitive advantage. We're going to take our message to a much larger audience because the passion that we have to help investors not lose money when the markets are down is what keeps us up at night. That's the excitement level of bringing strategies to the table that can do that. When we see a prolonged low growth period, which is my fear is a prolonged low growth period. I think that's the fear of most. I'm not necessarily worried about big crashes. I mean, look at what happened in April. Yeah, the headlines, looking at your statements, was certainly no fun. But, generally when something dips big, you see some sort of a rebound pretty quickly until it doesn't happen. And then it stays down, which, that could happen as well. But when we can craft the portfolio, because you don't have, once you stop working, unless you have passive income could be real estate, could be business investments, whatever. But the cash flow most of the time is generated from the portfolio. And in addition to Social Security, maybe some pension income. And so I get why people are nervous. I understand that. And it's even more reason to focus more on below the line investments. And what I mean by below the line, use zero as the line. Use zero as the market line. What do you have inside your portfolio that if the markets are down, that's still going to give you above the line, which is positive returns? And if you don't have that, if your advisor can't show you that, if your advisor can't literally chart your investments below the line and above the line, and if the markets are below, if what kind of return they'll be, just use consider zero the line, then you're just not with an advisory firm that I think you should be. So that's the about us, and that's the why us, candidly. And it has nothing to do with individuals. I like to think everybody is a great personal person. But this is your money, and this is your future generation's money as well. And the markets are risky, and there's a lot of uncertainty. And so if anything we talk about on the radio piques an interest, certainly would love to talk with you this week. 630-492-1912, 630-492-1912. Happy Father's Day to all the dads out there. We look forward to being back with you next week. More after the break. No more breaks. Show's over. I am done.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.